Welcome to The Explainer. Today, we are tearing into a massive structural shift in global power, and more importantly, exactly what it means for your clients' portfolios. I am super excited to guide you through this because, frankly, we're looking at two absolute heavyweights in the space. Now, if you're a financial advisor navigating the current market, you already know the energy transition is a dominant theme. But there is a very specific, undeniable catalyst supercharging this sector right now, and it's fundamentally altering the trajectory of global energy. So let's dive right into the multi-billion-dollar question that literally every financial advisor is fielding right now. How do you actually invest in AI's massive power appetite? Because let's be real, the true play here isn't just buying up more tech stocks, it's the physical power grid itself. We all see the daily headlines about data centers and the insane computational power needed for AI model training. But here's the catch. You can't run those chips on good vibes alone, right? They require highly reliable 24/7 electricity. You need massive baseload power and a completely modernized grid infrastructure to deliver it. That is the ultimate bottleneck. And getting your clients positioned in the companies resolving that bottleneck, well, that is arguably one of the most compelling infrastructure plays of the entire decade. All right, here's our game plan for today's explainer. We'll start with the AI energy supercycle, meet the grid titans, compare solutions versus standardization, break down GE Vernova's financial momentum, look at legislation and regulatory tailwinds, and finally, deliver the advisor's portfolio verdict. Okay, let's kick things off with Section 1, the AI energy supercycle. Now, HDIN Research puts this perfectly. They define this not as some flash-in-the-pan temporary spike, but as a deep structural shift. We're talking about a solid 5 to 10-year runway of visible revenue for power infrastructure. Think about that for a second. In a market that's usually obsessed with what's happening next quarter, these companies are staring down a decade of highly predictable structural demand. They've successfully pivoted away from being traditional hardware manufacturers to becoming the absolutely critical underlying infrastructure partners for the new digital economy. To really wrap our heads around the scale we're talking about, consider this number, 5 gigawatts. The Williams Data Center project here in the US alone ordered 5 gigawatts of power generation equipment from Siemens Energy. 5 gigawatts. Just to put that into perspective, that is enough juice to light up several major cities, or, roughly enough to power a few million toasters simultaneously, and it's all dedicated to a single project. Because of this, Siemens Energy actually expects orders directly tied to data centers within its Grid Technologies division to quadruple by 2028 compared to where they are in 2025. The demand is, quite frankly, explosive. Moving right along to Section 2, let's meet the grid titans. When you break down the core metrics of these two companies, you'll immediately spot a clear split in both geography and growth strategy. Siemens is really digging its heels into Europe. They're driving growth through highly complex grid technologies, things like high-voltage direct current, or HVDC, and offshore connection solutions, which are primarily fueling European grid modernization. GE Vernova, on the flip side, is leaning heavily into its electrification segment and its highly profitable gas power services. They are directly feeding the insatiable demand of North American hyperscalers. But here is the kicker. Despite the different approaches, both are targeting incredibly robust profit margins right near that 20% mark by 2028. Which brings us perfectly to Section 3, Solutions versus Standardization. This is where it gets super interesting because these two are taking wildly divergent paths to capture this market. Siemens is playing the solutions card. They're betting heavily that the market needs deep, bespoke, turnkey engineering. They're heavily promoting their Blue portfolio, which is premium, environmentally friendly grid equipment that completely eliminates the use of harmful SF6 gases. GE Vernova, totally different playbook. They're going all in on standardization. Operating under a ruthless lean management philosophy, they are laser-focused on standardized, high-demand workhorse products. The goal is to slash complexity and drive costs into the floor. Plus, they're layering on smart software, like their GridOS platform, to help data centers dynamically orchestrate massive power loads. And if you want hard proof of GE Vernova's aggressive North American push, look no further than their massive $5.275 billion buyout of Prolec GE. Right now, transformers are literally one of the biggest choke points in the entire global grid supply chain. By buying out the remaining 50% stake in this joint venture, GE Vernova isn't just buying a revenue stream. They are buying certainty. They're securing massive manufacturing capacity right here in the Americas to guarantee they can churn out and deliver these standardized products to their hyperscaler clients without a hitch. I absolutely love how HDIN Research sums this up. Siemens Energy offers deep technical expertise and global project capability, while GE Vernova offers operational efficiency and strong exposure to the high-growth North American market. It really hits the nail on the head regarding the strategic dichotomy you can present to your clients. Do they want the bespoke, deeply technical European engineering approach, or are they looking for the lean, volume-driven North American manufacturing machine? Both are totally valid, but they definitely behave differently in a portfolio. Let's pivot over to Section 4, GE Vernova's financial momentum. And just a quick aside on why we're zooming in on GE Vernova here. Their recent 2025 financial results laid out some spectacularly aggressive public guidance that gives us incredibly granular, juicy data points to analyze. $200 billion. Let that sink in for a moment. That staggering number is what GE Vernova expects their total equipment and services backlog to hit by year-end 2028. And they expect their electrification backlog alone to double. Think about the sheer revenue visibility that gives a company. They aren't out there hoping to scrape together customers next year. They literally have $200 billion worth of work lined up and waiting. This even includes a massive 80 gigawatts of combined slot reservation agreements and backlog just for their gas turbines. Tracing their financial trajectory here, you can see a really compelling narrative of intense margin expansion. They closed out 2025 with just over $38 billion in revenue and an 8.4% margin. Fast forward to their 2028 outlook, they expect to hit $52 billion in revenue. But look at the margin. It jumps to 20%. That means they aren't just growing top-line revenue, they are becoming exponentially more profitable as they scale out that lean standardization strategy. Oh, and over that same period, they expect to generate a jaw-dropping $22 billion in cumulative free cash flow. And here's why growth-focused investors are paying very close attention. GE Vernova is absolutely proving its commitment to returning value to shareholders, all while keeping an investment-grade balance sheet. Because they're throwing off so much free cash flow, they recently doubled their quarterly dividend and massively increased their share repurchase authorization to $10 billion. They have committed to actively returning at least a third of their cash generation directly to shareholders. That makes it an incredibly attractive proposition when you're looking at capital allocation. All right, on to Section 5, legislation and regulatory tailwinds. Keeping things strictly objective, we have to look at the legislative moat protecting these infrastructure investments. Two landmark U.S. laws, the Inflation Reduction Act and the Infrastructure Investment and Jobs Act, are acting as massive accelerators. They provide direct tax credits and funding that perfectly align with the exact grid technologies these titans are deploying. Whether we're talking production credits for onshore wind and nuclear, investment credits for storage, or direct funding for grid modernization, these frameworks dramatically improve the economics of these massive projects, which directly benefit suppliers like GE Vernova. So the big takeaway here is that global legislation is actively subsidizing the massive manufacturing capacity expansions needed to meet this AI energy demand. Knowing that demand is effectively locked in by private tech giants on one side and public legislation on the other, these companies are confidently spending capital globally. GE Vernova is dropping $200 million in Vietnam to build high-voltage direct current transformers and expanding a century-old hub in Italy by $30 million to ramp up production of bushings, which are vital for global transmission networks. They are aggressively fortifying their global supply chains to meet this exact moment. Finally, let's bring it all together in Section 6, the advisor's portfolio verdict. When you're sitting across from a client and they ask how to play the AI power boom, here is your cheat sheet. You can confidently contrast Siemens' technical global depth against GE Vernova's high-margin North American efficiency. If your client wants exposure to premium bespoke engineering and the massive European grid recovery, Siemens Energy is the clear structural play. On the other hand, if they're looking for aggressive margin growth, incredible free cash flow, major shareholder returns, and a direct standardized pipeline to North American data centers, GE Vernova's model is an absolute powerhouse. Look, both of these companies offer incredible exposure to the AI energy supercycle. The grid is no longer just some sleepy, boring utility play. It is literally the beating heart of the AI revolution. So I'll leave you to consider, which titan fits your specific investment strategy? Which approach, complex bespoke solutions or ruthless standardization, do you believe will generate the most alpha for your clients over the next decade? Thank you so much for joining me on The Explainer today, and happy investing.